morning. I am Dilek Pekdemir, Research Manager at EPRA. Welcome to our first EPRA Research Webinar of 2024. We are pleased to host 3 webinars dedicated to sponsored EPRA research papers under 2023 Academic Research Programme. Today, we will start the first webinar series. The paper presented by the University of Geneva, the Volatility of Listed Real Estate in Europe and Portfolio Implications. This webinar will be moderated by Alex Moss, Director at a Research Center at the Bayes Business School, and also he is the Chairman of EPRA Research Committee. The 2 authors of the paper are today with us today, Jacqueline and then Louise. They will present and then answer the questions. Here on the screen, you'll see the QR code. If you want to download the paper, you can download using this QR code on the screen right now. Also, I just kindly remind you that if you have any questions, please just put in the chat at the end of the webinar. We will have a kind of a Q&A session. Also, I just want to remind you that our webinar series will continue in February and then in March for the other 2 research papers. You see the QR codes that if you want to register, please just do it using the QR codes. Also, another reminder for you, the full paper of those research papers will be available at the day of the webinars. And then you can also reach out all the research papers on our website dedicated to academic research papers. So now, before just losing the time, I will just give the floor to Jacqueline, who will present the paper. Jacqueline, the floor is yours.
Yes, thank you. Okay, thank you very much, Dilek, and many thanks to EPRA for giving us an opportunity to do this paper and to present it today. So this paper is a joint work with my colleagues Martin Hoesli and Louis Joner, and as it was already mentioned, its full version has been published on the EPRA's website. Oops. So first, let me give you some idea of what we actually do. So we all know that during the past 20 years, the markets have experienced 3 significant shocks, and these are the global financial crisis, the COVID pandemic, and the most recent period of increased inflation. And these large price movements that usually appear during shocks are, of course, a major concern for investors, because they have a strong impact on the volatility, and volatility is one of the major considerations when constructing investment portfolios. And therefore, against this background, these are the 3 major things that we do in this paper. So first, we analyze how the volatility of European listed real estate, both across sectors and across countries, has changed during the past 20 years. Second, we study weather volatility and also deviations from NAV can be used by tactical rebalancing in order to improve the performance of listed real estate portfolios. And finally, we also study whether tactical rebalancing affects the allocation to listed real estate in a mixed asset portfolio. So now let's briefly discuss the data and the method. So for listed real estate data, we use the indices of 5 main sectors, and we also use the indices for 6 largest European markets. And for the method, it is divided into the 3 parts. So first we estimate volatilities with the gauge, and then identify high versus low volatility regimes with Markov regime switching model. Second, we perform a listed real estate portfolio analysis, and for this we use 5 strategic allocation approaches, and these are equally weighted, capitalization weighted, maximum Sharpe ratio, minimum variance, and also risk parity. And we test 2 tactical rebalancing methods on this. And these methods are volatility-based one and also net asset value based. And we also include some kind of control portfolio that does not have any tactical rebalancing. And finally, in part 3, we derive optimal allocations for portfolios that consist of listed real estate, but also of stocks and bonds. So now let's move to the results. In this webinar, I will only cover the major results for sectors, but in our full paper, you can find all the remaining results, which include country analysis and also numerous robustness checks. So first, let's look at these figures that depict volatility and also volatility regimes for our 5 listed real estate sectors and also for stocks. And what we see that overall the high volatility regime of the GFC lasts longer than that of the pandemic, and we also see that the responses to both shocks vary a lot across sectors. So, for example, during the GFC, the volatility was the highest for the residential and industrial sectors, while office and retail sectors had volatilities that was even lower than that of stocks. However, during COVID, we see that volatility was the highest for the retail and to a lesser extent for the office sector, and while the residential sector appeared to be the most resilient one. And these results are very consistent with the fact that both retail and office sectors were badly hit by the pandemic. We know that retail was affected due to the strict quarantine measures, mandatory shop closures, and the related increase in e-commerce, while office sector experienced a massive shift to the remote work, and this trend is still very, very popular. Okay, now let's look at this figure that refers to the second part of our paper and shows portfolio compositions for each of our 15 investment strategies. Overall, we see that allocations vary substantially across strategic approaches, while the impact of tactical rebalancing is much less noticeable. And we observe that capitalization weighted approaches are largely overweighted in the diversified sector, as it is the largest sector in Europe, and it also has quite big allocations to retail and to residential sectors. While for the maximum Sharpe ratio approaches, we see that the allocations are concentrated in the industrial sector and to a lesser extent in the residential sector, and this can be the result of the strong performance of these two sectors after the European debt crisis and especially during COVID. For the minimum variance portfolios, we see that these are mainly allocated to the office sector, and this is likely due to the fact that office sector was considered for a long time till the COVID pandemic as some type of a safe haven for real estate investors, given the long maturity of office leases. And finally, for the risk parity approach, we see that there is no sector dominance. Okay, so what about the performance? First, our results show that tactical rebalancing leads to improved performance in the case of equally weighted capitalization weighted and risk parity approaches. And therefore, we can conclude that tactical rebalancing is beneficial for strategies that have relatively stable and well-balanced allocations. However, for the maximum Sharpe ratio strategies, tactical rebalancing results in even lower performance compared to using just strategic allocations. And this may be due to the fact that our tactical pockets are are mainly allocated to the diversified sector and also to the office sector, and therefore they kind of reduce allocations to the industrial and residential sectors. And we remember that these two sectors were the main constituents of maximum Sharpe ratio portfolios. And finally, for the minimum variance, we see that tactical rebalancing has no impact on the performance. Okay, now let's move to the third and final part of our paper. And here we see that allocation to listed real estate in a mixed asset portfolio ranges from 4 to 26%, and we can conclude that it is the highest for those strategies that are more dynamic and also allow for more concentrated positions. What about stocks? We see that their allocation ranges from 16 to 36%, and it is inversely related to listed real estate. And finally, we see that corporate bonds have the largest weights of almost 50%, while government bonds are stable at 15%. So what are the key results? First, we show that even though volatility shocks are synchronous across sectors, they of course differ in magnitude. Second, we show that tactical rebalancing is beneficial for strategies that have a stable and well-balanced allocations. And third, we find that the allocation to listed real estate in a mixed asset portfolio ranges from 4 to 26%. And overall, our paper contributes to a better understanding of LRE volatility dynamics, and also shows practical implications for constructing both listed real estate and mixed asset portfolios. And finally, our results are also useful for investors in the case that they can use publicly available information when they want to allocate their funds to listed real estate. Okay, that is it. Thank you very much.
Great. Well, thank you very much indeed, Jacqueline. That was absolutely fascinating, and obviously volatility, a very key topic for 2023. I've got a few questions, and just a reminder to everybody, if they can put their questions in the chat box, and I'll also read them out. I've also got a reminder, we only have 10 minutes, a very strict regime here at EPRA. So if I can start off with my first question, I'm very interested in the sort of tactical rebalancing that you have, and obviously interested in the strategic side, but on the tactical rebalancing, and we've done some work on this as well, how exactly does that work in terms of how often do you rebalance, how do you determine how to change the weightings, etc.? What's the mechanics behind the sort of the rules-based rebalancing strategies?
Thank you very much for your question, Alex. That's a great question. I will try to bring you just a quick overview. Obviously, on the paper we have a very detailed discussion how it works, but general idea is that, in fact, first we have a strategic asset allocation strategy. So it can be an equally weighted portfolio, a capitalization weighted portfolio. We test also maximum Sharpe ratio, minimum variance, risk parity. And in normal time, in fact, you have your entire portfolio, which is allocated to your strategic asset allocation. So for example, your portfolio is fully invested into a maximum Sharpe ratio strategies. And this strategy works with monthly rebalancing, where in fact we invest each month, we rebalance the portfolio, we invest the dividend proceed, and obviously we reallocate the portfolio based on the strategies. And at this point in time, we also check if there is triggers to enter into a tactical asset allocation. The trigger works is totally a systematic framework, so it's based on statistical model. It's here that we use the modeling with the Garch and the Markov model, and I'm not going to enter into the details today of that. But the point is that as soon as we the statistical model, see that we are or in a high volatility regime, if it's a volatility-based tactical asset allocation, or in a low price to NAV regime, if it's the case where we allocate using price to NAV, we'll create a tactical pocket, and this tactical pocket will represent 20% of the portfolio, and we'll invest only on the sectors which are currently in a high volatility regime or low price to NAV regime. And we keep this tactical pocket for up to 12 months. And in fact, the only reason that could trigger a liquidation of this pocket is, or if we reach a total return of 50%, so it's like the profit-taking level, we liquidate the pocket, or we have also a stop loss level if the return on the tactical pocket is below minus 10%. Obviously, this is parameters, the 12 months, the 50%, the minus 10%. They are all somewhat arbitrary. That's why in the paper we test a various number of other parameterization, and what we find is that the result that we found in terms of performance is quite robust across the choice of parameters.
Got it. That's very interesting. And I think one of the fascinating things about this, you've used not just volatility, but also the relationship of price to NAV within that paper. Can you explain a little bit about how you do that in terms of the deviations from NAV?
Sorry, I'm not sure I get your question.
Sorry, in terms of you've got the volatility, but you've also looked at deviations from NAV. Yes. In terms of your method. Can you explain how you sort of measure that and how you look at that?
Yes. So first of all, we rely on the NAV which were provided by EPRA. So obviously it's a huge advantage when we work with the European data, because we have NAV which are provided by the company. They are published with regular interval, and what is great is that it's appraisal-based NAV. It's constructed in a kind of bottom-up way, starting with the appraisal of the properties. So for us, it's a huge advantage to have this NAV, because in fact we can put into relationship the price signals with the fundamentals. Obviously, using this kind of NAV are also some drawback. They can be smoothed as they are appraisal based. They are probably a little bit backward looking, especially when we compare that with what happened on the listed market, on the stock market. But still, it permits to put into relationship the price signals with the fundamental value of the LRE. And in fact, we use this ratio in our tactical rebalancing, and we use simply a Markov regime switching model. And the goal is simply to classify at each point in time the price to NAV ratio as being or in a low price to NAV regime or in a high price to NAV regime. Sorry. And what is important to realize is that we don't invest simply because, for example, there is a discount to NAV. We really have a trigger into the tactical allocation if the price to NAV is lower than it used to be in the past. So, for example, you can have a company which used to trade at a 35 or 40 premium to NAV, and suddenly the price dropped to a 5% premium to NAV. And here we have a buy signal which will enter into our trading systems, because in fact we realize that this price is more advantageous in terms of NAV than what was the case by historical comparison.
Very interesting. And you mentioned there, obviously, you've got the European data, fabulous data from EPRA. Do you think it would make a difference if you applied this regime to, say, the US? I mean, that you'd have different sectors, for example, which might have different characteristics. But do you think these results are particularly European-centric, or you could apply them broadly globally?
Very interesting question. First of all, we don't have this data for US, so it will be impossible to apply the exact similar setup. So that's great for me because I can answer what I want, and you have no way to prove that I'm wrong. Now, more seriously, it will depend. Probably what we'll find. The advantage with this European data is we have obviously this transparency, and the number of sectors is quite limited. On the US market, obviously, we have a largest numbers of sectors. You have also a lot more, the weight of alternative sectors is far higher in European. We have a market which is mostly focusing on the traditional sectors. So we have a lot of diversified REITs, and then we have the usual suspects, retail, office, apartment, and industrial. In the US, you have a lot of these specialized sectors, alternative sectors, which are probably more operationally intensive, and it's probably like a more focused strategy. So it's quite hard to imagine what will happen if we have the same kind of framework on the US market. But what is sure, and even for the European market, it will be interesting to maybe goes out of this idea to work with index or by country or by sectors, and maybe try to work with individual REITs. So really use an allocation which goes at individual REITs, where we work with individual names. Obviously, it's a lot more work, but it will be very interesting.
That's it. I was going to say that was sort of my final question, really, which is obviously the results are going to be determined to a certain extent by the starting composition of the country and the sector portfolios. You know, so we can think of different countries and a huge weighting to different sectors. I just wonder, sort of going forward, what you think sort of the next steps might be in terms of developing this. Would it be those custom-based sort of indices that you could create yourself to smooth out, if you like, that country bias or sector bias? Or might you even consider something like incorporating leverage as a factor in terms of the what I think you call it strategic allocations, I call it more like smart beta type sort of weightings. But have you thought about expanding that to more like a sort of farmer French factor model, or sticking with the typical weightings that you've got now?
Yeah, very interesting question. For the moment, we have no plan to expand this work, but I guess there is a lot of avenue on which you can work to expand this work, and there is a very interesting idea. Obviously, in the result that we have, we can have a bias because obviously the sectoral allocation is not always the same across countries, and the reverse is true. The country allocation is not always the same inside sector indices, and it can create some, I guess, some bias in how we interpret results. So it will be very interesting, as I said before, to go working with individual LRE companies, but also obviously to integrate other factors. Leverage is probably an important factor, obviously, but there is other factors. The traditional model like FAMA and French are very interesting. I think that there is now some research which incorporate factors which are more specific to the LRE market, which will be very interesting to integrate. And for me, there is one big open question is that obviously the difference between where REIT is or LRE company is listed and where the building are can also have a huge impact. So obviously you can have a company which is trading in Switzerland on the stock exchange, but are building in Germany and France only, and that also create a bias that it will be very interesting to control. Obviously, it will require a lot of hard work because it's not a easy problem to solve.
Excellent. Well, thank you for that. I'm conscious that we've now hit the sort of 30 minutes mark, which is our limit. So I very much look forward to that paper being produced. And thank you so much, both of you, for both the slides and for the hard work in terms of the the presentation. Look forward to the paper and look forward to joining everybody at the next EPRA webinar shortly. Thank you very much.
Thank you very much.
Thank you.